There is a 3-digit number that controls your life. You didn't vote for it. You can't opt out. And the company that created it answers to no one. Act 1, the number that runs your life. Right now, somewhere in a data center, an algorithm is deciding whether you deserve to rent an apartment, whether you can get a car loan, whether your insurance costs $900 a year or $2,400, whether your job application gets a second look, whether the interest rate on your credit card is 12% or 29%, all of it, every single one of those decisions, flowing through one number, your credit score, and most Americans have no idea how it actually works. Not really. They know the vague outlines. Pay your bills on time. Don't max out your cards. But the actual mechanics, the hidden levers, the ways the system is designed to keep you paying and keep you dependent, that part nobody explains. Until now. Let's start with the number that should make you angry. 200 million. That's how many Americans have a credit file with the 3 major credit bureaus, Equifax, Experian, and TransUnion. 200 million people. Every credit card they've ever opened, every loan they've ever taken, every late payment, every address, every employer, cataloged, scored, sold. And the company whose model is used for roughly 90% of all lending decisions in America? A corporation called Fair Isaac, better known as FICO. FICO did not invent the credit bureau, but in 1989, they invented the score. The single number that collapsed an entire financial history into a 3-digit judgment. They didn't ask your permission. They didn't notify you. They just started scoring you. And the banks, who desperately wanted a fast, cheap way to approve loans, bought in immediately. Within a decade, the FICO score had become the operating system of American financial life. And FICO had become one of the most powerful private companies most people have never thought about. Torn on Act 2, the birth of the score, and the man behind it. To understand why the credit score works the way it does, you have to go back to 1956, San Jose, California. An engineer named Bill Fair and a mathematician named Earl Isaac founded a consulting company with $400 in startup capital and a single idea. Decisions made from data beat decisions made from intuition. At the time, getting a loan in America was an entirely human process. You walked into a bank, you sat across from a loan officer. He looked at you, your clothes, your handshake, your face, your name, and decided whether you were creditworthy. This sounds personal. What it actually was discriminatory. Loan officers were almost exclusively white men, and studies of lending patterns from that era consistently show that Black applicants, Hispanic applicants, women, immigrants, all were denied at dramatically higher rates than their financial situations justified. The bias wasn't hidden, it was the system. Fair and Isaac's pitch was, replace human judgment with math. The math doesn't see your face. The math doesn't care about your accent. The math looks only at your behavior. It was a genuinely progressive idea. And for a while it worked. Lending became more accessible. Discrimination, at least the explicit face-to-face kind, got harder to sustain. But then the system calcified, and something interesting happened. The math started to replicate the discrimination it was supposed to eliminate, just more quietly. Act 3, how the score is built, and where it gets weird. Here's the official breakdown of what goes into your FICO score. Payment history, 35%. Do you pay on time? Amounts owed, 30%. How much of your available credit are you using? Length of credit history, 15%. How long have you had accounts? Credit mix, 10%. Do you have different types of credit? New credit, 10%. Have you recently applied for new accounts? Simple enough, right? Except the devil is in every single detail. Take payment history, 35% of your score. Seems fair. If you pay late, your score drops. But here's what the model doesn't distinguish. A person who was 30 days late on one credit card payment because they lost their job for a month is treated almost identically to a chronic non-payer. A single missed payment can drop a score with otherwise perfect history by 100 points. 100 points. Gone. For 1 month of financial difficulty, and that mark stays on your report for 7 years. 7 years. No matter how perfectly you pay every bill from that moment forward. Now take the amounts owed category, 30% of your score. This one is called credit utilization. The rule of thumb you hear is keep your utilization below 30%. Use less than 30% of your available credit limit. But FICO's own research suggests that people with the highest scores, 800 and above, typically keep their utilization below 10%. Here's where it gets strange. Your credit limit is not a reflection of your financial health. It's a number a credit card company assigned you. If you have a $1,000 credit limit and you put $400 on your card, your utilization is 40%. Your score suffers. If you have a $10,000 credit limit and you put $400 on your card, your utilization is 4%. Your score improves. Same spending behavior, different score, entirely because of a limit that was assigned to you by a lender. And how do lenders decide your limit? Partly based on your credit score. Your score influences your limit. Your limit influences your score. It's a loop, and the only way to climb it is to already be inside it. Now the length of credit history, 15% of your score. This is the one that punishes young people most brutally. You cannot build credit history without credit accounts. You cannot get credit accounts without credit history. It is a wall with no door. The system's solution is a secured credit card. You deposit $500 as collateral, and you get a credit card with a $500 limit. You use it, pay it off, and slowly over years you build a history. But during those years, your score is artificially low. Not because you're financially irresponsible, but because the system hasn't had enough time to evaluate you. A 22-year-old who has never missed a bill payment in their life, never been late on rent, utilities, phone, can have a worse credit score than a 45-year-old who has declared bankruptcy twice but has been managing accounts for decades. The system does not care about your character. It cares about your history within the system. Act 4. The three bureaus, a cartel with no oversight. FICO makes the score, but FICO doesn't collect the data. That job belongs to the three credit bureaus, Equifax, Experian, and TransUnion. These are private companies, not government agencies, not public utilities, private for-profit corporations. Their job is to collect information about you from every lender, every creditor, every bank you've ever interacted with, compile it into a credit report, sell access to that report to anyone who pays for it. And the scale of this operation is extraordinary. Equifax alone holds data on more than 800 million consumers worldwide. It processes over 3.5 billion data updates every month. 3.5 billion updates every month to a database of your financial life that you did not consent to being built. Here's the part that should genuinely alarm you. In 2017, Equifax suffered one of the largest data breaches in corporate history. Hackers accessed the personal information, names, social security numbers, birth dates, addresses, driver's license numbers of 147 million Americans, nearly half the country. The breach went undetected for 78 days. Equifax chief security officer at the time had a degree in music, not cybersecurity. The system that holds the keys to your financial life was being guarded by people who were, to put it generously, not prepared for the responsibility. And the penalty? Equifax ultimately settled for up to $700 million with the FTC. $700 million sounds enormous until you remember that Equifax annual revenue is over $5 billion. They paid at most about 14% of 1 year's revenue for exposing the financial identities of half the American population. Then they went back to business. And the errors, the catastrophic, life-altering errors. The Consumer Financial Protection Bureau, the CFPB, estimates that approximately 26% of Americans have a material error on at least one of their three credit reports. 26%. 1 in 4 people walking around with incorrect information in the file that determines their financial fate. Wrong balances, debts that have been paid showing as unpaid, accounts that belong to someone with a similar name, debts past the statute of limitations still listed as active. In 2012, the FTC published a landmark study. It found that 5% of consumers had errors serious enough to result in them paying more for products like auto loans or insurance. 5% of 200 million people is 10 million Americans. 10 million people paying higher interest rates, higher insurance premiums, being denied apartments because of a mistake in a database they don't control. And the process of correcting those errors? You dispute the error with the Bureau. The Bureau contacts the creditor who reported it. The creditor has 30 days to respond. In most cases, the creditor simply confirms the information they already submitted without actually investigating. Studies have found that the dispute resolution process results in corrections in fewer than 20% of cases where a material error exists. You can be wrong, you can prove you're wrong, and the system can shrug. To Act 5, the score is product, how your number makes them rich. Here's the business model that nobody talks about. FICO doesn't make money from you. They make money from the people who judge you. Every time a lender pulls your credit score, they pay FICO. Every time a landlord runs a credit check, they pay one of the bureaus. The 3 credit bureaus collectively generate over $12 billion in annual revenue. Equifax alone cleared $5.3 billion in 2022. The product they're selling is you, your history, your behavior, your number. And here's the recursive genius of it. The worse your score, the more you need to borrow to fix your life. The more you borrow, the more data you generate. The more data you generate, the more valuable your file becomes. The more lenders pull your file, the more money flows to the bureaus. The system profits from your financial struggle. But the bureaus don't stop at credit data. In recent years, all 3 major bureaus have built massive data analytics businesses that go far beyond credit. Equifax Workforce Solutions Division sells income and employment verification services. They have payroll data on more than 54 million American workers. Data provided by employers who use their payroll processing services. Think about that. The same company that tracks whether you pay your bills on time also knows your salary, your employer, your employment history, your job title, and they sell access to all of it. Experian markets a product called Marketing Services, data about your purchasing behaviors, lifestyle indicators, and demographic characteristics. Sold to companies that want to target you with advertising. They're not just scoring your credit. They're building a complete commercial profile of your life and monetizing every layer of it. To Act 6, the insurance trap, where the score leaves finance and enters everything. Here's the moment the credit score stops being a financial tool and becomes something else entirely. Most people know their credit score affects their ability to get a loan. Fewer people know this. In 45 states, insurance companies are legally allowed to use your credit score to set your insurance premiums. Your car insurance, your homeowner's insurance, your renter's insurance, not your driving record, not your claims history, your credit score. The insurance industry calls it the credit-based insurance score. It's a slightly modified version of FICO calculated specifically for insurance pricing. And studies consistently show it has an enormous effect on what people pay. A 2020 study by the Consumer Federation of America found that drivers with poor credit paid an average of 97% more for auto insurance than drivers with excellent credit, even when their driving records were identical. Nearly double. For the same coverage, for the same risk, because of a number on a financial database. Now let's follow the logic of who gets hurt. People with poor credit are disproportionately low income. They're disproportionately people of color. They're disproportionately people who experience financial disruption, a medical emergency, a job loss, a divorce, not chronic irresponsibility. Those people pay more for insurance, more for loans, more for everything, which leaves them with less money to save, which means they're more likely to struggle financially, which means their credit score stays low or drops further, which means they keep paying more. It is not a bug, it is the architecture. And what's most alarming is that the insurance industry's justification for using credit scores is statistical. People with lower credit scores file more claims on average, but correlation is not causation. People with lower credit scores may file more claims partly because they live in neighborhoods with worse infrastructure, drive older cars, live in older buildings, all downstream effects of having less money. The credit score is being used as a proxy for poverty, and poverty is being priced as a risk factor. 7. The employer trap. When your score becomes a job application. In 47 states, employers are legally allowed to run a credit check on job applicants, not for financial positions specifically, for any job. A 2012 survey by the Society for Human Resource Management found that 47% of employers used credit checks for some or all job candidates. Think about the logic of this for a moment. You lost your job, you fell behind on bills, your credit score dropped. You're now applying for a new job to fix your financial situation, and the employer sees your credit check, sees the missed payments, the collections, the elevated debt, and passes on your application. You can't fix your finances without a job. You can't get a job because your finances are broken. The system has created a trap from which mathematical escape is nearly impossible without external intervention, and the legal protection is weak. The Fair Credit Reporting Act requires employers to notify you if they run a credit check and to give you a chance to explain negative information. But it doesn't require them to hire you, and it doesn't require them to explain how much the credit check influenced their decision. Check date. The score in the age of algorithms. What's coming next? If the current system alarms you, wait until you see where it's going. FICO is not the only game in town anymore. In the last decade, a new generation of alternative credit scoring companies has emerged. They argue that the traditional FICO model excludes too many people. The 26 million Americans with no credit file at all, the credit invisible, and that new data sources can fill the gap. What data sources? Your rent payment history, your utility bills, your bank account cash flow, your cell phone payment record. So far, relatively reasonable. These things do reflect financial behavior, but some companies have gone further. Startups have proposed using social media activity, the way you type on your smartphone, the time of day you apply for a loan, the education level of your social connections, and your GPS location patterns as inputs into creditworthiness models. The rationale: big data finds signals in everything. The problem: those signals often encode exactly the same demographic biases as the face-to-face loan officer from 1955. If you live in a low-income zip code, your GPS data will reflect that. If your social connections are disproportionately low income, your social graph will reflect that. If you work night shifts because that's the only job available to you, your application timestamp will reflect that. The bias doesn't disappear when you feed it into a machine learning model. It hides. In China, this trajectory has already reached its endpoint. The Chinese social credit system, which is actually several overlapping government and private systems, not one unified score, goes far beyond financial behavior. It incorporates whether you jaywalked, whether you were caught smoking on a train, whether you criticized the government on social media, whether your friends did any of those things. High scores unlock privileges, cheaper travel, faster loan approvals, priority for your children's school applications. Low scores result in being banned from buying plane tickets, train tickets, being listed publicly as a discredited person. American advocates for credit system reform point to China not as the destination, but as the direction. When you build a system that reduces human beings to a number, the incentive to add more data never stops. The algorithm always wants more signal. The number always wants to become more complete. The question is where the line is, and who draws it. ACT 9, the fight back, and the cracks in the wall. For the first time in decades, there is serious political and regulatory pressure on the credit scoring system. The CFPB, under Director Rohit Chopra, launched the most aggressive regulatory campaign against the credit bureaus in the agency's history. In 2022 and 2023, the Bureau issued a series of reports documenting error rates, inadequate dispute resolution, and the Bureau's expansion into data brokerage. In January 2025, the CFPB published a rule that would have removed medical debt from credit reports entirely. An estimated 15 million Americans carry medical debt on their credit files, debt that studies show has almost no predictive value for future loan repayment. States have moved independently. Colorado, New York, and California have all passed or proposed legislation restricting employer credit checks. Multiple states have introduced bills to ban insurance companies from using credit scores in setting premiums. VantageScore, a competing scoring model created by the three bureaus themselves to challenge FICO's dominance, has expanded its model to include rental payment history, reaching millions of previously unscored consumers. And FICO itself has released new versions of its score, FICO 9, FICO 10, that treat medical debt differently, that look at trending data over time rather than just snapshots, that attempt to be less punishing of single catastrophic events. The changes are real. They are also relative to the scale of the problem, small. Finale, the real insight. So here is where we land. The credit score was built to solve a real problem, human bias in lending decisions. And in narrow ways for specific populations, it worked. But the solution calcified into a system. and the system developed its own interests. FICO went public on the New York Stock Exchange. Its stock ticker is FICO. Its market cap has exceeded $15 billion. Its executives are compensated in the tens of millions of dollars annually. Equifax, Experian, and TransUnion are publicly traded billion-dollar corporations. Their incentive is not your financial health. Their incentive is the continued demand for their product. And their product, the thing that generates the revenue, the thing that justifies the stock price, is the score that everyone is forced to care about. If Americans stopped needing credit scores, these companies would cease to exist. So ask yourself, are these companies incentivized to make the credit system simpler, fairer, more transparent? Or are they incentivized to make it complex enough that everyone needs to pay attention to it, opaque enough that most people don't fully understand it, and pervasive enough that opting out is impossible? Here's the insight that reframes everything. The credit score is not a neutral measurement. It is a product designed to be consumed by lenders. Its accuracy, how well it predicts your future behavior, is optimized for the lender's benefit, not yours. And the entire apparatus of financial education around credit scores, the articles about improving your score, the apps that let you track it, the services that monitor it, all of it exists to make you a more compliant participant in a system that was not designed with your interests at its center. The advice is always, play the game better. Improve your utilization. Don't open too many accounts. Don't close old ones. Use credit to build credit. Nobody asks, should this game exist in its current form? Should a private corporation, accountable to shareholders rather than citizens, hold this much power over this many lives? Because if you ask that question, the entire architecture looks different. It stops looking like a neutral measuring tool. It starts looking like a control system, a system that rewards compliance, punishes disruption, converts financial vulnerability into higher costs, and extracts maximum value from the people least able to resist it. The 3-digit number doesn't just measure your financial life, it shapes it. And the people who design the shape, the ones who decide which behaviors get rewarded and which get penalized, which data gets included and which gets left out, are not regulators. They're not elected officials. They're not accountable to you. They're companies with shareholders and quarterly earnings calls. And the score they built? It's working exactly as designed.